Welcome. In today's lecture, we'll be focused on the taxation of investment securities. Understanding how different types of income and investments are taxed is crucial for making informed financial decisions. Let's start with a thought experiment. Imagine an investor who purchases an asset for $100. By the end of the year, the asset's value has increased to $150. If the government imposes a 100% tax on the capital gain, the investor owes $50 in taxes. Additionally, if there's a 20% wealth tax on the asset's value at the beginning of the year, the investor owes another $20. After taxes, the investor is left with $80. This extreme example illustrates how tax policies can significantly impact investment returns. There are three types of income to consider. 1. Ordinary income generated from active work or business activities such as salary payments and royalties. Tax rates range from 10% to 37%. 2. Portfolio income generated by capital, including interest, dividends, and capital gains. Interest, non-qualified dividends, and short-term capital gains are taxed as ordinary income, while qualified dividends and long-term capital gains have lower tax rates, up to 20%. 3. Passive income. Income from businesses or investments in which the taxpayer does not materially participate, such as limited partnerships, S-corporations, and real estate. Ordinary income comes from active work, such as salary payments and royalties. In 2023, the US federal tax rates for ordinary income range from 10% to 37%. Usually, gains from investment assets are not taxed as ordinary income, but there are exceptions. Portfolio income is generated by capital and includes interest, dividends, and capital gains. Interest, non-qualified dividends, and short-term capital gains are taxed at ordinary rates, while qualified dividends and long-term capital gains are taxed at lower rates, with a maximum of 20%. Passive income comes from activities where the taxpayer does not materially participate, such as rental properties and limited partnerships. Passive income is taxed at ordinary rates but is not subject to employment taxes like Social Security and Medicare. Passive losses can offset passive income, but not other income types. The basis of an investment is its original cost, adjusted for fees and improvements. When an asset is sold, the basis is subtracted from the sale proceeds to determine the taxable gain or loss. Basis rules prevent double taxation by ensuring income is taxed only once. Inherited assets have a tax basis equal to their fair market value at the decedent's death. This stepped-up basis can reduce capital gains taxes when the inherited asset is sold. However, income in respect of a decedent or IRD assets, like IRAs and annuities, do not receive a stepped-up basis and are fully taxable upon distribution. When property is received as a gift, the donor's basis and holding period usually transfer to the recipient. If the property's value is lower than the donor's basis, the recipient has a double basis, which affects the gain or loss upon sale. Depreciation allows for the recovery of an asset's cost over its useful life. Depreciation reduces the asset's basis, preventing double recovery of the investment. When the asset is sold, the reduced basis is used to calculate the taxable gain or loss. Dividends can be taxed as ordinary income or at the lower long-term capital gains rate if they are qualified. Qualified dividends must meet specific holding period requirements to receive favorable tax treatment. Capital gains occur when an asset is sold for more than its basis. If held for more than 1 year, the gain is long-term and taxed at lower rates. Short-term gains from assets held for 1 year or less are taxed at ordinary rates. Capital losses can offset capital gains, and if losses exceed gains, up to $3,000 can offset ordinary income each year, with the remainder carried forward. Passive losses can only offset passive income. These rules prevent high-income taxpayers from using passive losses to reduce other income. Unused passive losses can be carried forward to future years. The NIIT applies a 3.8% tax on certain net investment income for individuals, estates, and trusts with income above specific thresholds. This tax impacts high-income investors and their returns on investments. The AMT ensures that high-income individuals pay a minimum level of tax. It affects the taxation of investments like qualified small business stock and incentive stock options, potentially increasing tax liability. When an equity security is sold, the gain or loss is recognized and taxed. The calculation is based on the sale amount minus the adjusted basis. Long-term gains are taxed at lower rates, while short-term gains are taxed at ordinary rates. Stock splits increase the number of shares and decrease the price per share proportionately, with no immediate tax impact. Stock dividends generally are not taxable, but certain conditions may trigger tax liability. Warrants allow shareholders to buy new shares at a discounted price with no current tax impact. Spin-offs, where a company creates a new independent company from its division, are not taxable if shareholders don't have a choice between cash or shares. Short selling involves selling borrowed stock with the expectation of buying it back at a lower price. The gain or loss is recognized when the position is closed and it's taxed at the capital gains rate. A wash sale occurs when a security is sold at a loss and a substantially identical security is repurchased within 30 days. The loss is disallowed for tax purposes, but is added to the basis of the repurchased security. Investors can use different methods to determine the basis of stocks sold, including 1. FIFO, first in, first out. This method assumes the oldest shares are sold first. 2. Specific identification. This allows the investor to specify which shares are sold. 3. Average cost method. This method averages the cost of all shares purchased. Interest on corporate and US government bonds is taxable at ordinary rates. Municipal bond interest is generally tax-free at the federal level, but may be subject to state and local taxes. Bonds issued at a discount or premium have additional tax considerations, such as original issue discount (OID) rules and market discount rules. The tax treatment of real estate depends on its use. Investment properties are subject to capital gains tax, while personal residences have specific exclusions for gains. Section 1031 allows for tax-deferred exchanges of like-kind properties. REITs must derive at least 75% of income from real estate and distribute 90% of income as dividends to avoid entity-level tax. Mutual funds pass through income to shareholders, who are taxed on dividends and capital gains distributions. The tax treatment of options depends on whether the position is long or short and how the option is disposed of. Futures contracts are marked to market annually, with gains or losses treated as 60% long-term and 40% short-term. Understanding the tax implications of different investments is crucial for effective financial planning. By being aware of how various investment vehicles are taxed, you can optimize your portfolio for after-tax returns. Thank you for joining us in this lecture on the taxation of investment securities at University Name. Let's continue our journey towards becoming proficient investors.